In this video I will tell you exactly how to calculate the intrinsic value of every listed company. We will also see why different analysts reach different results in evaluating companies, but let's start from the beginning. Why stock prices goes up and down?
Stock prices in the long run follow the corporate results. Look at this chart. We have the Apple stock price, and together plotted on the chart we have the Apple sales. As you can see, with the growing of sales, also the price of the stocks grown. In the long run, stock prices follow the corporate results. That's it, guys. This is something really important that we have to keep in mind in order to understand how to calculate the fair value or the intrinsic value, as you prefer to call it. So in this case, we have, as you can see in the picture, three scenarios, because if in the future the results, the sales of Apple will continue to grow, for sure Apple stock will grow. But we also have other two scenarios, because the results could go stable in the future, but of course the results could fall. And of course, if the sales will go down, also the stock prices will do it. We have to understand something else, because in order to understand which is the correct stock price for a company in this moment, we have to understand, and we have to try to guess which will be the future results of the company. Okay, so if we would like to understand exactly what the fair value is, we can say that Apple future stock price is nothing more than its future sales discounted to today at a correct interest rate. Understanding and calculating the fair value of a company, in this case Apple, is very simple. What is difficult to do is to guess the future results of a company, okay? Because if we know exactly which number will do, which sales, which net income will do a company in the future, calculating the fair value, calculating the correct share price is something really simple. We will see the formulas in this webinar. So I would like to make an example to you. I prepared also an Excel file. When we would like to choose an investment, of course we have many options, like in this image. We can buy bonds, we can buy funds, we can invest in real estate, we can buy currencies, precious metal, option trading, many things. So we have to find something we can use to compare different kind of investments. And for example, if we would like to understand which is the risk-free example of an investment, all around the globe we use the T-bond, which is the United States bond. Okay, we can also find it in the forecaster. Look, this is the T-bond, the Treasury yield 10 years. As you can see, at the moment, if we give money to the United States government, we get back 4.58% in return. The United States are a very powerful country with a strong army and many other things. We assume that the 4.58% of return we get investing in the treasury, we can call it a risk-free investment. It's quite impossible that United States will declare bankruptcy. Okay, which is the fair value of 100 euro, dollars, or pound, whatever you want, in 2029? Because as I told you, the secrets in order to understand the fair price of a stock today is to have the future results. So in order to let you understand what I'm talking about, I would like to tell you which is the real value of $100 in 2029. Very simple, guys, because as you can see in these formulas, okay, we have to calculate how much does this amount of money worth today using a correct interest rate. As I told you here, Apple future price, we can write here fair price, is nothing more than its future sales discounted to today at a correct interest rates. Okay, so my question to you is, how $100, euro, what you want, in 2029 value today? And the answer is very simple, because here you can see the mathematical formula, and if we assume as a risk-free rate the treasury bond earnings, okay, so 4.58, we understand that the real value, the value of $100 in 2029, it's 79, almost $80. Okay, using this number, we already understand why interest rates are so important for the stock market. Because if, for example, United States from tomorrow decide to give me not the 4.58, but decide to give me, for example, 7%, look, the real value of $100 in 2029 today will be 71. Okay, if we switch back to 4.58, we can see the number increase to almost 80. Okay, and as I told you before, this is a number that I'm not inventing by myself, but this is today what the treasury, the T-bond, the treasury, give me as yield for 10 years. I would like to show you something else. What happens if I add an additional risk to my investment? Because if I would like to put some money in something with zero risk, this is the treasury bond, okay? Every other investments available all around the world will have more risk, of course, because United States is a very solid country. If, for example, I would like to invest, I would like to buy the equivalent of the treasury bonds, but for another country, for example, Greece, which is not strong as United States, and let's assume, for example, that Greece has got a 20% probability of declaring bankruptcy. Look what happened. This number dropped to 33. What does it mean? It means that if I would like to have in 2029 €100 or dollar from Greece, the maximum amount that it's intelligent to invest in Greece is 33, because Greece has got a huge risk compared to United States. We understand that we have to guess which will be the numbers that the company will do in the future. But how is it possible to guess this kind of number? Okay, and of course, in my opinion, and this is what we do in the Forecaster terminal, we do everything automatically, because in my opinion, it's impossible for me, Luca Di Scacciati from Switzerland, guess how many iPhone will Apple will sell in 10 years. Okay, so what we do is something really simple, because we go here on Excel, for example, and on the chart of sales and net income, here you have a bigger one, but this is exactly the same you find here in the Forecaster terminal. Okay, we put the linear and logarithmic trend line on the results. Okay, so for example, it's very easy, because here in Excel you can add a trend line and you add a linear regression line. We do the same. We add a trend line and we do the logarithmic, and that's it. We have two different lines. We do it also for the net income. And what you can see is something really interesting. We have two lines that goes directly in the future and will tell us, using the past data, which could be both the net sales and the net income. Starting from 2024, probably the net income will be in this area. For example, if we are talking about the net income in 2029, probably we'll have something like this, because using these statistics, we know which is the annual growth rate of the Apple results, and we can project these results in the future. Okay, so using this technique, we will know exactly which kind of numbers we will have, for example, in 2029. Because in the case of sales, the future sales of Apple will probably stay inside this area. I made something really intuitive to let you understand how will be the future results of Apple. Because in this case, look, what I did is something really simple. We put the result of the sales exactly in the middle between the linear regression line and the logarithmic one. Using this technique, we don't have any kind of bias, guys, because, for example, if I will try to guess the amount of sales and the net income for a company, probably I will not have all the information regarding the company, the economy, and everything else in order to create a correct prediction for the future. Okay? And guys, just to be completely honest, we are talking about future, so it's impossible to predict the future. Okay, once we have this kind of results, we can calculate the fair value for the company. In the same way, we calculated how much $100 in 2029 value today. So now we know which is the correct growth rate for a company. We do not try to guess the future growth rate, we try to calculate it in a mathematical way. This is why, guys, for example, talking about a company like Tesla or talking about a company like Nvidia, you will find, for example, on the internet, so many different valuations, okay? Because especially for company that are growing really fast or has got a high future potential, okay, like Tesla, of course we have such a different valuation, because, for example, I think that Tesla will revolutionize the business of automotive, and so I think Tesla will do huge number in the future, but we also have someone that think that Tesla will go bankruptcy. It's important to understand that there is no one correct fair value, okay? Because it depends always from the future results. Nobody knows the future results. I would like to read with you this piece, which is taken directly from Peter Lynch, One Up on Wall Street book. The PE ratio, the price earning of a company that's fairly priced, will equal to its growth rate. This is very important, guys. The PE ratio of any company that's fairly priced will equal its growth rate. So, for example, if the PE of Coca-Cola is 15, you'd expect the company to be growing at about 15% a year. But if the PE ratio is less than the growth rate, you may have found yourself a bargain. This is very interesting, guys, because if, for example, we extract the number from this file, okay, look what I did. Here we have the results of the company until today, and here we have the forecast. If we go here in 2029 and we calculate the growth rate starting from today, we find that, talking about sales, we have a 27% of growth rate. Talking about net income, we have a percentage of 34. Okay, the median growth rate is 30%. Look what happened if we go to the fundamental page of Forecaster for Apple and we go and see the PE. At the moment is 25. The PE on the market is less than the actual PE, the expected PE for the future. This is why if you go and see the Apple fair value on the Forecaster, we find an undervalued company. Why quarterly results are so important for a company and why everybody wait for the quarterly results? Because in order to create the annual result, which is this one, every quarter we have some new information and we can understand if our prediction is correct or not. Akbar asked me, have you found if doing this extrapolation quarterly instead of annually improve the sales and net income prediction? Yes. And this is what we do on Forecaster. This is not everything, guys, because I made an example only using sales and net income. But what we do is going much, much deeper. Because, as you know, on the Forecaster, we have 3 different methods of valuation, okay? And if we go to the Forecaster, you can see, for example, that today, using the discounted cash flow for Apple, we find a fair value of 2024. With the Peter Lynch method, we find a 173 fair value. With the economic value added, we find a fair value of 133. The average results is 187, which compared to the actual price of Apple give us a undervalued situation of 11%. Okay, but why we use 3 different methods? The answer is very simple. Every single method target different zones of the balance sheet. So, for example, look the formulas. As I told you many times, Forecaster doesn't want to be a black box. We really would like you to understand from where the results come from. And in this case, you can understand why we use 3 different formulas. Because with the, for example, cash flow, we do this kind of calculation targeting the cash flow, okay? And not only the sales and the net income. For example, with the Peter Lynch method, we target only the earnings. And with the economic value added method, look at the formula, we use the NOPAT and the WACC and the TC, where the NOPAT is the net operating profit after tax, the WACC is the weighted average cost of the capital, and TC is the total invested capital. So using three different formula, we go and target different area of the balance sheet, and of course we have different results for every area. By mixing the three results together, we have such a strong valuation, such a, let's say, solid valuation, because, as I told you, we target different area. To let you understand better this concept, I use this example that I always use in Italian. It's the first time in my life I try to explain it in English. I hope not to say something strange. Try to imagine you would like to evaluate two different people, very different people, like Usain Bolt and Woody Allen. What you have to do to try to evaluate this so different kind of person? For example, we can use velocity, creativity, and the age. Of course, talking about velocity, Usain Bolt get 100 points on a scale of 100. Talking about creativity, I don't know, but let's assume he can get 10 points. And age is a number, so he's at the moment 37 years old. Talking about Woody Allen, probably compared to Usain Bolt, we can give him 1 point. Talking about velocity, 90% of creativity, because he's a great filmmaker, so we can give him 90 points on a scale of 100. And again, age 88 years old. If we do the average, we find that Usain Bolt is 49 in a scale of 100 and Woody Allen is 59. But of course, we cannot compare Woody Allen with Usain Bolt. They are so different kind of person. This example is very important in my opinion, because talking about stock valuation, we have to understand what we are looking for. Because, for example, a company which is good for me maybe is not good for you, or vice versa, as Usain Bolt is not the same person as Woody Allen. So, what are you looking on the market? Are you looking for velocity or are you looking for creativity? This is why it's very important when you go on the Forecaster terminal to understand what kind of company you evaluate. If you don't know a lot about the company you are evaluating, it's always a good idea to do a medium price of different kind of fair value. What is very important to say is that different people will have different result in the calculation of the fair value, because in every cases, what these people do when they evaluate a company is trying to predict the future results. In our opinion, the best results we have when we do not put our biases in some companies, okay, but we just use the statistics and the trend in order to understand which could be the future results. It's always important to understand that there is no exactly fair value for a company, because everything depends on the risks that you would like to take. Okay, guys, I remember to you something. Next week we will have a huge new release for the Forecaster. I invite you to the presentation of these new features. Okay, as always, we will do a webinar. Guys, I will leave you speechless. You will do like the girl in this image. You will do like this, because I will present you something new on the Forecaster that is something great you have never seen in the world. I will wait for you next week, because I have something really great to show you. I worked on these new features for months, literally, and I'm really happy to present it to you because you will fall in love again with Forecaster. Thank you very much and see you next week.